Hello everyone, welcome to another MakerDAO collateral call. Today is February the 3rd, 2021, 6 p.m. UTC. My name is Juan and I'm joined here by a bunch of Maker enthusiasts to speak about real world assets or real world finance, as our working group has renamed itself not long ago. Just to remind everyone about the dynamic of the call. If you have any questions or if you feel like saying something or comment, by all means, please do so. And yeah, Natalia from Reinno, thank you for being here.
Thank you so much for having us. Okay, so I'll try to share my screen. Let me see if it's gonna work. Are you guys seeing the PDF? Yeah, okay, awesome. So yeah, once again, thank you everyone for joining us for this collateral onboarding call for the Reinno stablecoin. And Reinno is a fintech startup that's trying to bring liquidity to commercial real estate through tokenization and blockchain-based lending. On this call today, we have 4 people from our team. We have myself, my name is Natalia, I'm the Chief Marketing Officer, and my background is in marketing, PR, and economics. We also have Victor, our CEO, whose background is in growing and scaling businesses. He's a serial entrepreneur, and he'll be talking later on about our price discovery and how we evaluate the assets when we tokenize them. We also have Chris, who is our COO. His background is in banking and IT. And we also have Christo, our CDO, who is he worked on several blockchain projects, and his background is in banking and data science. So he'll be talking more about the stablecoin, how it works, and how we use it. Okay, so right now, let's go a little bit back, and I'll tell you why we're doing what we're doing, basically. Real estate is a great asset. It's great for your portfolio to diversify, to grow wealth over time, but it's really not liquid. And most real estate deals require some sort of debt, which means that there's going to be a bank and a mortgage involved. With traditional banks, as we all know, they're super slow, they're not flexible, they require lots of paperwork and intermediaries. So at the end of the day, financing a real estate deal becomes really expensive. And even worse, let's say I own a $5 million building and I need to borrow just 1 million. But what the bank is going to do, it's going to block the entire property, and all of my equity is going to be locked by a bank, even though I just needed to borrow a fraction of what my property is worth. So this is really inefficient, and that's why we've decided to come in and try to solve this problem with tokenized lending. So for our solution, we first, of course, tokenize the property. So we create digital shares of a building or a portfolio. And then our clients are able to use these tokens as loan collateral to borrow money. So right away, you'll see that there is an increased flexibility. Since going back to that $5 million building example, now I will be able to deposit just the right amount of token as collateral. So let's say 1,500,000 worth of tokens to get that 1 million. And then the rest of my equity, so over $3 million in equity that previously would have been locked by a bank, is now free. I can hold it, I can sell it, I can use it for another loan. There are lots and lots of possibilities, especially if my financial needs change. I can do anything I want. And Reinno also offers an instant offer to our clients. Basically, we do all of the paperwork, due diligence, and assessment of the property during the tokenization. So when someone wants to borrow money, our system automatically connects that data to the tokens they deposit. And the algorithm, works it out, calculates the LTV and the interest rate, and our clients can get an offer instantly, which is not available at a regular bank. And of course, the tokens are independent. So if I own 10 tokens of a building and Victor, our CEO, owns 15, when I need to take a loan, he doesn't even need to know about it because my loan does not affect his ownership in any sort of way. In the traditional setup, the owners would have to come together and figure out how one of them could actually leverage his ownership, which of course is really inefficient again. With Reinno, the whole process is digital, paperless, and quick and easy. Now, what we've done so far, we launched Reinno in 2019, and a few months after the launch, we released a lending demo with all of the functionalities, the interface, and the risk model in the backend. Then in the beginning of 2020, we completed our first tokenizations. There were two different projects. One was the office building in Connecticut, and another one, a commercial real estate fund. And since then, the value of real estate that we tokenized reached $350 million. In September of 2020, we also launched a marketplace for tokenized commercial real estate, where investors from all over the world can invest in tokenized properties. And we really wanted to put the buildings that are going to perform well in the COVID-19 times. That's why you'll find there medical buildings and industrial facilities. As you know, with the boom of online shopping and e-commerce, warehouses now performing well. And I think that's what really allowed us to secure 11 million from investors on the marketplace for the deals listed there. And of course, we have some goals for 2020 and the future. One of them is reaching $1 billion in tokenized commercial real estate. We're already 30% there. And we have some clients that have several buildings. So we believe that if they're happy with the first tokenization, they'll be likely to come back for another one. And another goal is listing offerings on the marketplace that will be available for retail investors, and also reducing the minimum investment amounts. We believe that the new regulation and new rules from the Securities and Exchange Commission will make it possible. We're currently working on it. But of course, the major goal for us is issuing the first loan backed by tokenized real estate. And again, we already have the platform ready, the risk model. We have some clients that are willing to try this method and that want this flexibility. But of course, we're looking for funding for these loans. And connected to that, we are also planning to launch Reinno stablecoin, which is going to help us provide liquidity in a more efficient way. And Christo is going to tell you more about the stablecoin and how it works. So Christo, the floor is yours.
Thank you. Shall you just scroll to the present? Okay, you keep the presentation. So when we are talking about our approach to the Reinno stablecoin, I guess it makes sense to think of it in layers. So here on this slide, we are basically describing the first layer, which is people coming with tokenized commercial real estate, so with CRE tokens, and depositing them within a smart contract in order to get the Reinno stablecoin. The way that the Reinno stablecoin works is the exact same way that DAI would work, meaning that this is a collateralized debt position, which has certain collateral ratios requirements, certain liquidation ratios, and this is the way that we intend to maintain the peg of this coin. Essentially, what we intend to do for this is after the issuing of the Reinno stablecoin, some of it would go to a three-curve pool where we want to secure the liquidity for this token, and the other we want to use as collateral for a maker in order to issue DAI, meaning again to have a collateralized loans, not based on the CRE tokens, but rather based on the Reinno stablecoin. So Natalia, if we can move to the next slide, please. Right, so here is what I was explaining up to now, and for now I think that let's focus on the right-hand side of the slide. So there we can see the process where somebody buys CRE tokens. Those tokens have a certain value. This value is determined by the Reinno Oracle, which we might cover later, depending if needed. And pretty much those tokens are locked in a smart contract. We issue stable coins. We also incentivize people who do that with the Reinno governance token. And then people have the option to hold them, to sell the Reinno tokens, or to stake them in Maker in order to receive DAI in case this onboarding goes through. And the governance tokens are used for voting. On the left-hand side is just an abstraction of the same process where we are pretty much saying there will be users who are maybe not that blockchain savvy. So we want to make an abstraction of the whole process for them where they are able to just say, look, we have these CRE tokens. We want to deposit them as collateral, and the whole process, which is described in detail to the right, we do it on the back end for them and eventually finally just provide them with the loan which they're needing. But everything else is maintained for them on the back end. If we can move to the next slide, please. And here, obviously, we need to talk about how liquidations happens. And this is why I opened at the beginning that we need to think about this process in layers or in steps, because there are two different liquidation processes. So one of which is if the Reinno stablecoin, for example, deviates from the peg, or if there is interest accrued which is not enough and the DAI position needs to be liquidated, then DAI would need to deal only with the Reinno stablecoin and its liquidity, which would be provided by a tree-curve pool or the Reinno stablecoin being traded on exchanges. On the other hand, Reinno will have to deal itself with the liquidation of CRE tokens themselves and how this will happen in order to maintain the peg of the Reinno stablecoin itself. And obviously, as mentioned on the slide, we would also be providing incentives on both ends in form of Reinno governance tokens. So this is pretty much it regarding how we envision our setup. Obviously, this is open for discussion, but this is the direction which we are going to right now. So I think that Vic will take it over from here, just talking a little bit about the CRE tokens and their price discovery.
Christo, maybe we can do just a pause to see if there's any questions. Luckily, I'm joined by people that are much smarter than me, but for me, there are a lot of things going on at the same time, so it's hard for me to wrap my head around all the concepts. Why is there another stable coin, for example? Why is that needed?
Because we want to provide an abstraction where Maker would not have to deal with lots and lots of different individual CRE tokens, but they would have to deal with one single token, which will, and the price discovery and the liquidity for this token should be pretty straightforward, because we will have a tree-curve pool. And so the price discovery would not be centralized, meaning we will not be providing the value of the token ourselves, but rather this can be obtained in a decentralized fashion. This is the main reason.
So there's a pool that's created with all the, you're trying to buy property, and then that's where I get lost. It's like I don't see the cash flow or the value flow very, very clearly.
For which one? Can you specify, and maybe I can walk you through it?
Yeah, so maybe you can walk me through the process, or walk us through the process of how is the money moved, right? So if I'm an investor, why here there are two users and there's Reinno in the middle?
So let's go on the right hand side again. So let's start from the process from the beginning. Somebody has a real estate building and they want to tokenize it. They come to Reinno and they tokenize this building. They can obviously sell part of the tokens on our marketplace, or they can keep the tokens themselves. In either scenario, somebody holds tokens which represent shares within a commercial real estate building. Probably they might be looking for liquidity, they might be looking for a loan, so they want to have some liquidity based on those tokens. So we are offering them to take a loan against the tokens as collateral. Now, obviously one approach is that we would come to Maker with those tokens and we will say, okay, those are the tokens which you can use as collateral in order to issue DAI. However, this means that we'll have to do a separate process for each individual tokenized building, because each individual tokenized building has its own CRE tokens, meaning those are not just one, this is not just one token, those are different kind of tokens. And in order to provide a good enough abstraction of this, we have the process where we issue the Reinno stablecoin. So the Reinno stablecoin is all different kinds of CRE tokens deposited in CDPs, and we issue the Reinno stablecoin. Then with the Reinno stablecoin, we want to use this single coin, which represents all the CRE tokens which are deposited in CDPs underneath it, as collateral for issuing DAI.
Okay, I guess that
So-
when
so-
the... Well, go ahead, Long, sorry.
I was just going to ask, like, what was the choice? What was the thinking behind making Reinno like a stable coin rather than just like a non-stable pool of those assets, right? Like, because you essentially you've got two sets of loans happening here, right? You've got the locking of CRE in Reinno's like protocol to get Reinno tokens, and then you're doing that again in the Maker protocol. So it feels like that's maybe going to be less capital efficient, I guess, depending on the liquidation ratios of like both protocols.
We were talking about building an index, meaning a Reinno index, which represents all the different coins which are deposited there. But at the end of the day, we decided it would be a lot more efficient for us if we represent this as a stable coin. We put it in a three-curve pool, because then the price discovery would be pretty easy, and we would have to, we expect that like majority of the liquidations which we'll have to deal with would be on the Reinno side, not on Maker side, because then we know what is the expected value of the token.
In which situations would you expect liquidations?
In a situation where, for example, there is some significant devaluation of the real estate which is underpinning the Reinno stablecoin. So, for example, I don't know, maybe a building lost a lot of tenants, its cash flow would be reduced significantly. So at any time when the Reinno Oracle says that the value of the CRE token would fall below the liquidation ratio, which is defined within the CDP.
If you don't mind, can I also back up and ask just a general question? When you asked about the real estate being tokenized, so where does that get recorded in some state registry, or is it in its own entity and then you're tokenizing the equity of that entity, or how is the title traversed?
Victor can talk a little bit more regarding the legalities of this, meaning that after we are done with the stable coin itself, he will explain all the legal setup, how those tokens are issued, and what is the general setup behind that. He's just more prepared to talk about this than me.
I can explain now, but if you want, guys, let's leave it for. I mean, if there are no other questions for the stablecoin itself and the structure there, I can go directly to my part and basically explain you how we are operating from a legal standpoint.
Yeah, maybe I just have one last question for the stablecoin, because when someone borrow, okay, when someone okay, thanks. It's for when someone, let's say I have some CRE tokens, I want to borrow something. You give me some Reinno tokens, which is a stablecoin. I assume at some point there is an interest rate I have to pay.
Yes.
So that's the debt accrue in my vault in the Reinno protocol.
Yep.
But when I deposit Reinno in Maker to get DAI, do you expect there is also some kind of interest rate? For instance, if I have a 100 Reinno token, will I get 100 DAI, 99? And will there be an interest on the Maker vault?
Yes, we expect that there would be an interest on the Maker vault, and as with all other coins which are used as collateral in Maker, we expect that there is going to be a liquidation ratio and a collateralization ratio. I cannot tell you what those ratios will be right now out of the top of my head. Obviously, we'll have to discuss them with Maker in case the token is decided to be onboarded. So this is all up for discussion, but we are assuming that both of these will be present. We don't expect one-to-one conversion, and we expect interest on the DAI vote.
Okay, thanks.
So my question was maybe like a little bit more general. Like you mentioned kind of, you know, the whole first step, right, of minting the Reinno stablecoin. And I think you said just that you would aim to have like liquidity pools for Reinno, right?
Yeah.
To keep it stable, yeah. So my question then is, what do you actually need Maker for in that situation? If you've got a pool of liquidity which has got Reinno versus other stablecoins, which might even include DAI, right, or USDC or whatever, why do you need Maker to provide liquidity? I guess is my question.
Generally, the way that, as far as I understand, and I might be wrong here, that the way that the universal three-curve pool works, that it is one coin against LP tokens, meaning essentially it's not direct liquidity there. So obviously, first, we are expecting this to mainly act as collateral. So at the end of the day, even if the pool is relatively smaller, we would be expecting that this should be enough collateral to fund more loans than the size of the pool itself.
Right. I think I get that. So I kind of appreciate the point about LP tokens, but I mean, DAI presumably isn't what your customers want either, right? If they want to tokenize a building, they may want the loan in like dollars, right? Rather than, are you expecting them to yes. So you're already needing to do a conversion from like DAI to dollars. So like, how is that any different from doing the LP token, like the 3-pool LP token to dollars?
I am okay. So in this regard, this might be the same when we are doing everything on the back end for them. But again, just because of the mechanics of how liquidity would work, we are expecting that it should be possible to get more DAI, meaning that certain amount of a liquidity pool should be able to secure loans in DAI, which are a larger amount than the pool itself. This is our expectation. This is the main idea. Right. So because we are going to have different kinds of Reinno, so we are going to have multiple Reinno stable coins issued, meaning it is one kind, but a lot of them issued. At the end of the day, all of them can be deposited in a three-curve pool, but if nobody provides the counter liquidity for those tokens, meaning if nobody provides the curve LP tokens, this means that there would be a limited amount of tokens which are able to be withdrawn from this pool. So on the other hand, if we use this pool in its current liquidity as collateral for the Reinno token in general, we should be able to obtain more, let's say, more liquidity faster in this way by just using the pool as collateral. Because we are not expecting a lot of price movement on this, which means that the ratio of the disbursed loans to the collateral within the pool should be greater than what the pool can provide itself.
Yeah, so I see an issue here because you want a vault to bootstrap the liquidity, which makes a lot of sense. But in the same time, usually we need liquidity to be able to make the liquidation on our side.
Sure,
so there is some kind of circularity, I guess.
Correct. However, there is a difference between the pool needing to facilitate only the liquidations when they happen and the pool needing to facilitate the entire liquidity. So this is our point here, that at the end of the day, we do not expect that all of Reinno positions will be liquidated at once should this occur. Meaning, let's imagine that the liquidation ratio is set at 90%, for example. This means that at any given point in time, when there is a Reinno token fluctuation and we are opening new CDP positions with DAI, this would mean that they would be opened at a different price point for the Reinno token, if the Reinno token fluctuates. Which means at the end of the day, if we do have liquidations, they would not occur all simultaneously. And this is the point, that there can be a risk management depending on the current open positions.
Yeah, that makes some sense. Yeah.
So I guess
Oh, go ahead, Prost.
Sorry, I gotta add a more basic question. I guess I'm still not comprehending the CRE tokens themselves. Are those just a claim on the cash flow of a particular commercial project, or like what do those represent essentially for someone who initially holds them?
Yeah, I can get it. So basically, what the tokens represents is a share in an SPV, a special purpose vehicle that is owning the building, and you are basically the tokens are representing digital shares. That's what the tokenization setup that we are executing is. As well as on top of this, we do have a so-called fractional mortgage, which here in the United States is structured as is called UCC lien on the title of the property, which protects the property from being sold, being used as collateral for another mortgage or something like this. Potentially, that can provide additional risk for us. Yeah, and basically, as a shareholder, you're having proportional rights on the dividends and everything, and the decision making regarding the property. That's the commercial real estate tokens, basically what they represent.
So then, if I could a brief follow-up, I don't want to hog the floor, but then what are you guys doing to determine the pricing, I guess, on your end when you look at individual CREs going into the Reinno stablecoin?
Yeah. So first to start there. So first we're working on this process for more than 2 years to basically be able to identify the price of a token based on the underlying asset, and to be able to adjust this price over time, because that's the problem. I mean, you can identify price, the current price of an asset when you're tokenizing it, but then it's also very important to adjust that price over time. So in order to do that, of course, the first thing that we are doing, and the major one, is third-party assessment from an independent assessor, and basically that's a pretty normal procedure that the banks are executing. However, over time we are collecting also a lot of data regarding the cash flow of the building. You know, what are the tenants, what are the lease terms, and we are using this cash flow to basically additionally evaluate the price. Usually in the commercial real estate space, the asset evaluation is based mostly on the cash flow or cap rates. So that's why the cash flow is very, very important parameter. So when we are basically collecting information regarding the cash flow, and dividends are distributed through Reinno's platform, we are having a lot of information about that in real time. So every month we are seeing, you know, what's going to be distributed, and that way we can adjust even our valuations. But that's not the only thing. So we are now integrating with some third-party softwares and analytic tools that are able to provide you know, some information regarding, you know, pricing and stuff like this, which are again independent, and you can real time take and adjust the price based on that. So another way to basically update this information is more manual way. In the end of the year, you can collect some more information regarding the property, you know, new lease terms, some changes. For example, if there are significant changes, should be announced from the property owners. Like for example, I mean that's a pretty classic banking procedure as well. So if there is let's say a problem with a tenant, a major tenant, and the building has cash flow issue or something like this, they need to basically tells us so we can add the new data into our database, and this data is gonna use algorithms to recalculate the value of this asset. So that's how we can basically adjust our risk parameters. Another very important piece that we are building is the so-called Reinno internal grading system, which is not based. I mean, it's not the grading system like this office building is A class. It means that this is mostly it's efficiency from a energy standpoint. We are basically, what we are doing is more, we are rating them from an investment standpoint. For example, buildings which are graded with A class means that they're pretty safe investments according to our grading characteristics, and we can provide lower interest rates, higher LTV, stuff like this. And a good example of this grading is, for example, now with COVID, we saw an asset class that was pretty good prior COVID. The office buildings basically now are suffering and are one of the one of the asset classes which are suffering the most. Now definitely we can see them as a pretty risky investment. So such type of grading should be done over time for assets, and not only asset classes but also locations, because locations are changing as well. For example, San Francisco right now, it's suffering, so we can't evaluate, or I mean we can add additional risk factor for this particular area or downtown areas in particular right now, but that's gonna change at some point. Probably people gonna go back in big cities and downtown, so those grading criteria are taking into consideration asset class and geolocation. So all those systems that we have put in place are helping us to identify and discuss and be able to identify the price of a particular asset, and to be able to basically accept it into our protocol and as collateral into our lending system.
Going back just a question about the tokenization model of the real estate. So who actually owns the real estate?
The token holders proportionally. So
yeah, but step back for a second. I mean, not from the perspective of the county where the dirt is located. It's owned by an entity or a person. So who owns the entity?
So the real estate is owned by an entity. The entity is owned by the token holders. One token represents.
I get that part, but I'm talking about like if it's an LLC, who owns the LLC?
The token holder owns, every token holder proportionally holds shares in the LLC, and every token holder is basically a shareholder in that LLC. And so
then who is the asset manager of that LLC in the context of if there's a tax lien that's put on the property, who pays that?
So basically, the shareholders are appointing an asset manager who is managing the property for them. I mean, they're basically they're not active participants. They're passive investors, but they're the owners. While if there is an issue and something needs to be paid, it should be paid by the LLC and the cash flow of the building. So the property manager or the asset manager actually need to deal with issues like this. If, for example, however, if for some reason the shareholder is not happy with the asset manager or the shareholders, because they could be 2,000 people or more, they could vote the same way like a shareholding meeting is done, and they could decide to change the current asset manager.
Understood. So you're tracking who all the owners are for tax purposes also, correct?
Yeah, absolutely. We are having in-house cap table management solution. So whatever, even a transaction is executed outside of our platform or whatever, every token holder should be whitelisted. And at any given point of time, we were able to provide cap table to the regulators, which is required by that.
And just one final question related to the liquidation. So if you've got 1,000 people who own a given building and 2 people with their tokenized ownership proxy thereof, they decide they want to take this margin loan, assuming it goes through, and they ultimately cause a default. How does Maker get recourse in the context of it can't sell the building? It can only sell those fractional ownerships, and who would be the liquid provider for that liquidity source?
Yeah, I mean, we can get back to Crystal here to explain that basically, but I mean, Maker doesn't need to liquidate commercial real estate tokens, and that's not the point. We want to avoid this part and create basically another layer, which is solving this particular problem by issuing a stable coin. So basically, commercial real estate tokens are staked into Reinno stablecoin. Then Reinno stablecoin is issued, and then Reinno stablecoin. I mean, we are creating liquidity in Curve for it, which then is going to be used for liquidation. So if, in terms of liquidation, let's say a building is not performing, basically this liquidation should happen on Reinno's end. So we need to execute that. Maker is not going to be responsible for something like this.
So you mentioned like the people are providing liquidity on Curve a couple of times. Like, who do you predict is going to be doing that? Because they're going to need to provide Reinno stablecoins and 3-pool LPs, which is fine. But I guess the kind of the general plan is for like people to lock up CREs, get Reinno, lock the Reinno in Maker, and get DAI, right? So where does the Reinno come from that's going to go in the liquidity pools?
So initially we are going to provide some liquidity to the 3-curve pool, and subsequently we are going to provide incentives for people who want to also provide liquidity to the 3-curve pool in form of the Reinno governance tokens, and we are also thinking about what other incentives we can provide for that.
So the tokens you're providing directly, they're backed by CRE tokens as well, yes?
Correct, yes. All Reinno stablecoins are backed by CRE tokens.
Yep.
And the UCC lien, is that a blanket lien?
Sorry?
You mentioned something about a UCC lien. Is that a blanket lien?
I'm not sure what blanket lien should stand for.
It's where you give. It's where you provide the lender secure rights to the asset.
Yeah.
You mentioned UCC lien, right? Or am I
Yeah, definitely. Yeah, we're putting UCC lien, but because that's something that we're executing now. I'm not the lawyer in our organization. Even I'm working with a lot of documents, but so far we have never put UCC lien so far because we are now executing our first loans. We are working on our first loans now, so that's why I'm not familiar with difference and with the blank meaning, but yeah, I mean it's basically what we are doing is a UCC lien, which is securing the property and the rights, pretty much like a mortgage. And what Wall Street is doing compared with a mortgage, is cheaper and it's faster, and it's more flexible.
So the lien is on the dirt, and then that is securing all of the tokens so that another junior lien can't be applied?
Yeah. I mean, it could be applied, but it's going to be a second lien, like second mortgage. It's not going to be. This is going to be a senior loan, while if some other loans occur, because nobody stops you, if somebody is willing to provide funding or something or money, it could take a second position.
Just out of curiosity, have you evaluated this with counsel about what would happen during the course of a bankruptcy proceeding?
Sorry, can you say again?
With regard to a bankruptcy proceeding, if you had, I don't know, 2 or 3 people who had tokens file bankruptcy and a bankruptcy judge, have you engaged with counsel about how a bankruptcy would be treated?
Yeah. We do have two attorneys as part of our team, and I can't give you a really specific explanation how exactly that should work, but yeah, I mean, we can execute and take possession over the tokens in terms of default. If that's exactly your question, if I understand correctly.
Somewhat. I mean, the real, I guess the question I'm getting at is that, mortgage-backed securities, which you're just fractionalizing it smaller than a mortgage-backed security, but you can also buy a portion of a mortgage-backed security. They don't use LLCs and selling off securities. They put them in different structures that are bankruptcy remote. I was curious if you'd thought about how to approach that. That's all. You don't have to go into it now. It's fine.
Yeah. I'm not really familiar with the details, but we have discussed that with our attorneys. They don't see issues to basically do that. Our structure is a bit different than mortgage-backed securities for sure.
So I have another question. Have you given any kind of thought about how to, maintain Reinno's peg to like $1, right? Beyond like the just having a liquidity wall on curve.
So it will act similarly the way that DAI maintains its peg, meaning that we'll have liquidation in case it starts to go significantly below $1. This is the way that it is going to happen.
Right, but so the value of a stablecoin is to stay close to the $1 peg, right? People complain when DAI is at like $1, 1 cent. So yeah, I guess, have you got any have you thought any about like that? Because you kind of need to balance demand and supply of the actual stablecoin itself, rather than like even separately from like the loan portfolio and like the backing, right? You need to balance the demand and supply of the actual stablecoin. So like if there's lots of supply because lots of people want loans, then that's a lot of supply, but you might not have the demand there for people wanting to hold Reinno as liquidity wall tokens or in whatever form, right?
Sorry, but can you just reiterate the question? I understand that we need to balance supply and demand in order to have a Reinno stablecoin. So for the most part, let's put it like this, for the most part, if the token goes above $1, in our particular case, this is not a big issue by any stretch of the imagination. So obviously we want to be close to $1, but it going above $1 is not a problem. Our major problem is if it goes below $1 since it's used as collateral.
Yeah, for Maker, yeah.
Yeah.
So what is preventing it from going? I mean, even like a little bit below, right? Like 0.99 or 0.98.
So okay, so if it is going below, well, the basic idea is that the way that we set the liquidation ratio on the Reinno stable coins, probably this will have to be, let's say, those would need to have to trigger first before the DAI liquidation ratios trigger. So we will have to set the DAI loans in such a way that we ensure that if there is some price issues with the token, we first liquidate on our end, and this way we can restore the peg before DAI liquidates.
Right. Okay. I mean, the reason I'm kind of asking is because Maker has that mechanism as well, right? Like the first like SCD had that mechanism. You lock ether, you mint DAI, etc. When DAI is above $1, it makes sense to pay back vaults. When it's like, is that right? No, when DAI is below $1, it makes sense to pay back vaults, and vice versa when DAI is above $1. Right? Like that isn't enough to stabilize a stablecoin. It's what we've discovered, right?
Yeah, I fully understand what you're saying. However, as I mentioned, we do not need the Reinno stablecoin to be fully stable, to be perfectly honest. We expect that there are majority of the operations which are going to happen with the coin. So first, obviously, we need to delve into the economics of this, but majority of the reason why DAI has a lot of fluctuations is mainly because DAI is widely used. So there are a lot of things which can push it into one direction or the other. While the Reinno stable coin, majority it will be just listed, as we mentioned, on a three-curve pool, and we expect that a lot of our customers which want to take out loans will just come to us and say, we want a loan in US dollars, as you mentioned. So we'll have to facilitate the entire process for them. So at the end of the day, we do not expect that we will have this portion of the volatility which comes from the high usage of the coin, the same way that happens with DAI.
I mean, Christo, potentially the opposite is true. The smaller the market cap, the easier it is for one single player to just move the price by a lot. Like I can imagine that the euro dollar is much harder, or it requires much more capital to sway than I don't know, DAI or any other or any small stable coin, or well, doesn't even have to be stable. Any type of value store.
In a situation when we are talking about an adversarial attack, meaning that somebody wants to move this price on purpose, then I agree with you. Definitely a smaller cap token would be a lot easier to move. So I was talking about the situation with general usage, but when we are talking about somebody wants to move the price, sure, they can do that. We just need to investigate what kind of incentives are there for them to do that at the end of the day, meaning that they cannot really... the best thing which can happen, if we are looking at an attack vector for this, they might be looking to have some CRE tokens liquidated. But that's about it, meaning out of the top of my head, I cannot see a major reason for anyone doing that. That's not saying that it cannot happen, just that I don't see the reason behind that.
But I mean, even if the property going down or a couple of the token holders going bankrupt would have an impact on Reinno, this would be much more remarkable if you had 3 properties than if you had 100,000 properties. Just
of course, yes.
Okay.
You're completely correct there. So when we are talking about issuing DAI in exchange for Reinno as collateral, obviously we'll have to take into account the current liquidity of Reinno on the tree-curve pool. So pretty much, I guess, we should be able to understand what is the risk exposure at any different price point for Reinno. And this way we can determine a maximum amount of DAI, which can be issued depending on various collateral levels, on various liquidity levels which are there on the tree-curve pool. And this way we can do the abstraction for Maker in order to that they can deal only with the Reinno token.
So I want to go back to something you mentioned earlier, which was that if the Reinno token increases in price, that's not so much of a problem. So the way other assets work on like Maker, right? Like if the price of the collateral token goes up, that means there's more room for users to mint DAI from that token, right?
Yeah.
So
correct.
so if the price of the Reinno stablecoin goes up to say like, I don't know, 1.1, like that's quite an extreme example, but that means everyone can mint like maybe 8% more DAI, right? And that's fine until it goes down again back to 1, at which point they're all going to get liquidated if they don't deal with the situation, right? So
Sure, but yeah.
from Maker's perspective, we want it to be as stable as possible. I think it's not fine if it just goes up, because if it's fluctuating between like 1 and like 1.1, that's not great. That's like almost as bad as if it's fluctuating at like between like 0.995 and 1.005.
This will, of course, be a subject of further detailed discussions on how we want to handle this. But one simple solution would be to, in the case of the Reinno stablecoin as collateral, to assume a hard cap of the token at $1, meaning to not allow any minting of new DAI before above $1. And this way we would easily solve this issue.
Okay.
Yeah, and basically we can also always use this liquidity directly execute loans through the liquidity pool, and that's how we can reduce the price. I mean, if we do have a lot of demand from real estate owners to use our services, we can use that directly. And that's how we can deal with this price increase.
So I do have a question. So you were saying it's sorry, go ahead, Long. I was going to switch subjects. Go ahead.
I was just say like that's like not good for Maker, right? Like if you're directly doing loans from the liquidity pool, that cuts Maker out entirely, right? So that's not something we should really want to happen.
Yeah. I don't know if, as Christos said, I mean, I'm not saying that we should do it. I'm just thinking that, you know, that's a potential way to avoid that. Of course, if it doesn't make sense, we're not going to do it. It's a matter of further discussion. That's why we are here.
I guess I'm kind of picturing a scenario where, like, you know, Maker kind of onboards Reinno, and that kind of works well for the first few loans, and then at the point where it's bootstrapped, you just start doing loans directly from the liquidity pool, and you no longer use Maker at any point, right? At which point we've essentially bootstrapped a competing stablecoin, which is not good really for us.
No, we're not having such intention. That's why, I mean, I don't know if you're familiar. We really proposed a joint venture even with Maker to work on this, because it's very important for the entire community, not only for Reinno, but bringing real world asset is something that it's very important for the industry overall. So we're here to work together.
I have a question. You said that, you know, now I understand more that the assets are owned by an LLC. You're tokenizing the membership interests of the LLC. Is that like a Reg D offering that you're doing?
Yeah, it's Reg D and Reg S offering.
Right, and then are you putting it on the platform that you have that allows people to trade that? That's a broker dealer with.
For the initial sale, we don't need a broker dealer.
Correct.
We do need broker dealer ATS for secondary trading only. So we're gonna integrate with the broker dealer for the ATS, but we don't need to do that right away. There are other secondary trading platforms that we can use in order to facilitate secondary market. Yeah, but for the initial sale, we don't need broker-dealer license. We're aiming to take a crowdfunding license for smaller projects up to 5 million with the new amendment, which is allowing us to execute crowdfunding raises up to 5 million and to sell it to retail investors. But that's going to take approximately 6 months for the application to move forward right now.
Understood. Thank you.
Well, we're reaching the top of the hour now. I don't know if anyone has any last questions or comments. I don't know, Victor, Natalia, or Christo, if you want to say something else.
I can make just one final comment regarding the question, which was the one before that, regarding Reinno becoming a totally separate stablecoin. At the end of the day, we are a tokenization company, and we want to tokenize real estate and issue loans. We understand that Maker is a lot more integrated into the DeFi space, and this is why we are looking to leverage this relationship with you. So we are not looking to really integrate in, really develop in this direction. We want to do what we are good at, and this is tokenization and subsequently issuing of loans. Just to answer that one question.
That's very, very nice, I guess. Any other questions from the community? Okay, so I guess we'll wrap it up. Thank you, Natalia, Victor, and Christo for coming and presenting. It was really nice having you. And for those that are regulars in this type of calls, next week we'll have the Know Your MIM number 5. So we'll skip a week on the collateral types, and we'll have Lev explaining. I think it's MIM 43. I can't remember very well, but we'll see you all at Wednesday at 6 p.m. UTC. Thanks again.
Thank you, guys.